We all know that the single family sector in real estate has softened a little bit and has a little bit of volatility, specifically with the high interest rates coming or going up, low inventory. It kind of causes this unique situation where there's not enough houses. Some people can't afford them, so on and so forth. We're going to watch this interview with Bill Rudin talking about the state of commercial real estate. So let's go ahead and check it out together.
A few blocks south here of in Penn Station area. So there's definitely activity. April's number were like 2.7 million feet of leases. So it's healthy, but what's happening is it's the flight to quality. And we'll talk about the debt markets too, but tenants are gravitating to buildings that have great amenities, have the understanding that the owner can either has the debt already or can refinance the debt.
That's a great point. You know, since COVID, a lot of individuals went virtual. A lot of companies went virtual. A lot of companies shut down their high lease office spaces to go virtual. And if they are going to go, at least in my opinion, if they are going to go into commercial buildings, it does have to have some really cool amenities. Just like WeWork had, before they, filed for bankruptcy. But the amenities that WeWork had was revolutionary in compared to companies like Regus. Regus was WeWork's only competitor at the time, or one of the main competitors at the time, that really had old amenities. So this gentleman is on point.
And be able to fund the tenant improvements. So there's this tremendous flight to quality. Park Avenue has about below 10% vacancy.
He mentioned tenant improvement. Absolutely correct. If an individual is going to lease a space and the space has not been approved, a lot of times it should be placed in your lease, or you should at least think about it and say, hey, I want TI, I want tenant improvements on my suite.
We are seeing tremendous activity in that area because JP Morgan's new headquarters is going to open up next year. We just announced with the mayor and Vornado and Citadel a brand new building that's going to be built on 52nd and Park Avenue for Citadel Securities and Citadel company. Ken Griffin is the lead partner, and it's a 1,700,000 foot building. We just started the regulatory approvals to go through the zoning and get the building approved by the city, which will take about a year and a half, and then we'll start building sometime in 26. It's designed by Norman Foster. This
guy's just talking about the details of the property. I'm going to fast forward just a little bit.
And environmentally friendly, exciting component, and reaffirms New York City. It's Citadel's New York headquarters, but it will reaffirm New York as the financial capital of the world.
He's just trying to reestablish that, New York is going to be the financial capital of the world, so on and so forth, like it was back in its heyday.
We had Bruce Retner on about a week and a half ago, and he's a former New York City real estate developer. He's got a little more dour view, and it could be the difference between the A buildings and beyond. But let's listen in to what he had to say just a couple of weeks ago.
I'm excited to check this out because we really want to categorize different qualities of commercial real estate, A qualities, B qualities, C quality buildings.
Commercial real estate is in terrible trouble. I mean, you'll hear people say it's bottomed out. It's not going to bottom out. When you have vacancy rates in this city of 25% and occupancy rates of almost 50% or less than 50%, it can't recover. And that's because our whole nature of work has changed.
But what do you think about what he's describing, what he's saying?
There's significant vacancies, particularly in the Class B buildings. The overall average vacancy rate is about 21%, but certain segments on like Third Avenue have a 30% vacancy. But what we think is going to happen, the legislature and the mayor and the governor passed a couple of weeks ago up in Albany a conversion bill allowing office to residential conversions. And
office to residential conversions. That's an interesting concept because there are a lot of vacant buildings, or a lot of buildings that are predominantly vacant, that this would really help benefit convert into residential housing, and that would open up the inventory for traditional residential housing, whether that's, apartment style living or loft style living, and that'll help increase the affordability of homes.
You already starting to see companies, owners like SL Green has a building on 3rd Avenue, looking at possibly converting their buildings, some of their buildings to residential. Was that solve the problem? Definitely not. Do we have a nationwide issue in terms of debt? There's about $1 trillion of debt coming due in 2024, then in 25 and 20.
Those individuals that have been looking for particular real estate deals, this debt that's coming due on these balloon payments for commercial real estate might be a potential opportunity for some individuals to grab.
26, another $1 trillion. And again, it's the flight to quality. The buildings that have good leases will be able to get refinanced, albeit at higher costs. Owners may have to put some equity into the buildings. And then you have the distressed buildings, and that's going to have to go through the cycle of foreclosure. And then there's price discovery now. Right up the block here at 15 on Broadway, Upper Broadway, a building just traded for $300 a foot. Lower Manhattan, 222 Broadway.
That's down from what?
Pretty solid.
That's probably down from $600, $700, $800 a
All
foot.
right, so you're
So
talking
pretty
50%
solid, though.
haircuts.
at least some are even more. I've seen deals in Seattle and California at 60, 70 cents on the dollar, and you'll see that in the city too. But there's an opportunity at the right price. There's capital out there. There are opportunistic, people who see, value. The company that bought the building up on Broadway is a company called Yellowstone, not Mr.
TV
Cosner and co. But
I didn't share the beginning of this interview because this guy's jokes are they're as corny as mine, but he's a good guy.
they bought it at $300 a foot. It's a unique opportunity that this company, was able to take advantage of.
The Fed keeping rates higher for longer, the idea of these Fed cuts coming off, is that putting pressure on people to finally get to price discovery? Like,
No question about it. But I was very optimistic to hear your previous guest talking about, getting down to, below 4% interest rates. About an hour ago, I was giving him the thumbs up. We're below 450 now. When I was on the show back in September of last year, we were talking about, 4 or 5 or 6 rates cuts. Obviously, that conversation, has changed. But, speaking to our lenders, and I just got an email this morning from one of them. He said, "We're active. We're busy. People are stepping into the market.
Yeah, absolutely.
And trying to lock in their loans. I think maybe they should wait a little bit longer to get the
price discovery was not something you were going to.
I definitely agree with that. I definitely agree with what this gentleman's saying. If you're looking to hop into the market, whether that's the commercial sector or residential sector, if you got the cash and you have the ability, just kind of chill and relax, wait a little bit, because some more opportunities are going to come float by the end of quarter 3 or quarter 4. Or at least this is my predictions. By quarter 3, quarter 4, we'll see a different landscape of available residential and commercial housing.
To see, as long as it looked like the Fed was going to imminently cut rates.
Yes.
Because that offers a lifeline to people. If you wind up with no rate cuts for this year, that kind of forces some action.
Yes, but you're seeing, I just read in Goldman Sachs residential portfolio in San Francisco, about $600 million of debt. They're handing the keys back. So you're going to see that. I don't think it's going to be, a dramatic one-time hit. It's going to be rolling over the next year or two.
I definitely agree with that. Over the next course of year, individuals are going to attempt to postpone any delinquencies or any types of, giving back the keys or foreclosures on any type of residential or commercial real estate over the next 12 to 24 months. I totally agree with that.
And as interest rates go down, there's obviously opportunities for people to be able to restructure their loans. You're going to see people restructure their loans. You're going to see loans get defaulted, and you're going to see people step in at the right price to take advantage of the opportunity.
Given the price discovery.
Absolutely. I hope this was super valuable to you guys. You can go ahead and check out I basically did the whole video, but if you want to see the entire video in its entirety, I'll go ahead and place a link for that down below. I'd love to get your thoughts on the state of commercial real estate as we're talking right now in 2024. Hope you guys have an amazing day. Chat soon.